Thanks for tuning in to another educational video from Savvy to Prosper. Today we're going to discuss how much house can you qualify for, understanding mortgage qualification and Fannie Mae Freddie Mac requirements. Now let's discuss why understanding your qualifications is important before starting the loan process. Affordability. It helps to determine how much house you can actually realistically afford without financial strain. Loan eligibility, knowing your credit score, your income, debts, ensures that you meet the lender requirements. Better planning allows you to prepare for down payments, reserves, and closing costs. Confidence in the process equips you to make informed decisions and avoid surprises during the mortgage process. So before we jump into understanding the qualifications you need to have to get approved for a mortgage loan, let's discuss who Fannie Mae and Freddie Mac are. Fannie Mae, which stands for Federal National Mortgage Association, and Freddie Mac, which stands for Federal Home Loan Mortgage Corporation, are government-sponsored enterprises that were created to support the U.S. housing market. Their primary role in the mortgage process is that they lend not directly to borrowers, but they buy the mortgages from the lenders. That helps provide liquidity to the housing market and it helps to stabilize the housing finance system. What impact does this have? Their involvement makes home loans more accessible and they're more affordable for millions of Americans by ensuring there's a steady flow of funds to mortgage lenders. So basically, when you go out and get a mortgage loan from your bank, that loan will be sold to Fannie Mae or Freddie Mac, which will in turn provide the funds back to your bank so they can keep on making other mortgage loans to others. Now we're going to discuss key factors that determine how much house you can actually afford. The first factor is your income. Now there's two types of income, your gross income and your net income. The gross income is the amount of income that you earn that without any taxes being taken out, and your net income is your actual take-home pay. Debt to income ratio, that becomes important in also the qualification process. The amount of debt that you're carrying versus your income, your credit score, and then the reserves, the amount of actual money that you have in the bank. Now let's discuss Fannie Mae and Freddie Mac general requirements in qualifying for a mortgage loan. Minimum credit score is typically 620 or higher. Maximum DTI, which is your debt to income ratio, generally needs to be up to 45% to 50%. Usually over 45% will require additional requirements to qualify for that. Income documentation, you'll need to have your W-2s, tax returns, and pay stubs to show the income that you've earned from your employment. Reserves, typically you'll need between 2 and 6 months of mortgage payments. Now let's go over an example, an actual typical loan that you might see. So here we're looking at a base scenario, a purchase price of $380,000. Now regarding the purchase price, it's going to be very important that you deal with a experienced realtor to help you to make sure you get the best value for the purchase that you're making. So you want to look into making sure the person actually understands the market that they're dealing with. Now regarding that purchase price of $380,000, with typical down payment, which is about 5%, it's going to be about $19,000, which leaves you with a loan amount of $361,000. At $361,000, with our interest rates, current interest rates about 6.5%, you're looking at a principal interest payment of about $2,269. Property taxes, and this is based in Texas, we're looking at about $468 a month for property taxes, estimating about 1.48% tax rate. Insurance, about $208. That's about $2,500 per year. HOA, if there is an HOA, looking at about $50, $600 a year, which gives you a mortgage payment, total mortgage payment, which is your principal, interest, taxes, and insurance of $2,996. So, considering a mortgage payment of that amount, almost $3,000, and not having any other debt payments, your debt to income ratio would be about 45% based on a yearly gross income of about 80,000. So what does that mean? You need to earn about $80,000 a year with that max rate of 45% to buy a house of at around 380,000. What do you expect in regards to closing on that mortgage? You'll need about 2 months of reserves, which is almost $6,000. Estimated closing costs. Now this may vary. So average is about 3%, but that's something that you could negotiate with the seller to have them pay those closing costs. If you're not able to get those closing costs covered, then you're looking at about $10,830. The down payment, as we mentioned earlier, about $19,000. So total cash to close for a house for this house in this scenario would be about $35,822. Like I said before, if you can get the closing costs covered by the seller, that would decrease this amount by $10,830. So that gives you an idea of how much you can afford in regards to house. So if you make about $80,000 a year, you probably can afford a house of $380,000 with a 5% down payment. Now, if you're able to put a bigger down payment, of course, that brings the loan amount down and you're able to afford more home. Or if your income is higher, of course, you can afford a larger or a more expensive home. So that gives you an idea of regards to a mortgage loan, what you're looking at in regards to payment and amount you need to bring to the table to afford this home. Next, let's discuss the credit score impact on interest rates. So there are three main ranges in regards to credit score. Basically, the top tier would be 740 and above, which is considered excellent credit score, and it will give you probably your lowest rate on interest rates on your mortgage loan. Then you have the next tier, which is from around 700 to 739, which is still a good credit score, and it'll give you a pretty good rate, but just not the top tier rates that you would get at the 740 or above. And then there's below 700, which will qualify you for a mortgage, but the rates will be a little bit higher on those. And we'll be discussing in the next slide on how you can improve your credit score to get closer to those top tier rates. Now let's discuss some things that you can do to improve your score prior to applying for a mortgage loan. Of course, the most important thing is to make sure you pay your bills on time. That's the biggest factor in affecting your score. Next is the utilization of your credit. You want to make sure that you aim for about 30% max use of your credit limit. That usually gives you your best score. Also, you want to keep your old accounts. The long history of credit accounts helps you increase your score as well. The next thing that's going to be important for you to do to help you boost your credit score is pay down your debt. Like I mentioned in the previous slide, your credit utilization is important to keep it low, but also decreasing the amount of debt that you have will also improve your debt to income ratio in qualifying for the loan. Make sure you limit new credit applications. Keep it to an absolute necessary. If you really need to apply for credit, then go ahead and do it, but it's best to not apply for any credit applications at least 6 months prior to applying for a mortgage loan. And also, it's important to monitor your credit report. Check for errors and inaccuracies and dispute them with the credit bureaus prior to applying for your mortgage loan to make sure you have the best credit score possible before you apply. Also, make sure to diversify the type of credit that you have. For example, if you only have credit cards and you've never had a car loan, it's looked at negatively if you only have had one type of credit in your past. So it's always good to make sure to try to have different types of credit prior to having or going out for a mortgage loan. That way that they can see that you are responsible with not only credit cards but also with a mortgage loan and other types of credit. Now, if you're just getting started with your credit, it's also a good idea to possibly apply for a secure credit card. to help you either rebuild your credit or start your credit. So basically, that what that is getting a credit card that is uh, established by you depositing a certain amount with the bank. So, for example, let's say you deposit with the bank $1,000, they'll give you a credit card with a limit of $1,000. So that will secure them and making sure that they get paid. As you build your credit up, then you won't need to have a secure credit card, and you can actually get a credit card with no security deposit attached to it. So similar to what I showed you earlier, it's also good to look for tools and resources like the mortgage calculator that I showed you guys that will help you in guiding you how much you can afford for a mortgage loan, where you're able to type in, the amount of income you have, or from perspective of the price of the house, you can see, based on different types of costs or purchase price of homes, you can calculate how much you can afford with different interest rates and see what your income would need to be to afford those homes. Also, it's important to look at your credit. There's tools out there, for example, Equifax, Experian, TransUnion. You can go onto their sites and monitor your credit there. There's also companies out there like creditrepair.com that can help you repair your credit. And there's also nonprofits, for example, the Credit Counseling National Foundation for Credit Counseling. They can help you also to help you repair your credit. And of course, there's also financial education resources like this one here, Savvy to Prosper, where you can get additional information to help you in your journey to improving your credit and also getting approved for a mortgage loan. Now, if you want additional tips and resources and tools that you can use with your financial journey, you can follow us on Savvy to Prosper on Facebook, Instagram, and YouTube. Thanks for watching. Bye.